Hi there, thanks for joining us again for another edition of Ask a Fool. I'm Jason Moser, an analyst with Motley Fool One, and today we're taking a question from Stephen Anderson. Stephen asks, common investment advice is to have 25 to 50% in bonds. However, is this still applicable given the current rates, the current interest rate environment, or are there other investments that could or should be held in lieu of this? And Stephen, I'm glad you asked this question. First of all, I think for every investor, this is going to be a little bit different, to be sure, and your tolerance for risk will help guide your allocation decisions in regard to bonds specifically. So the first move, whenever I'm looking at any kind of allocation discussions, really is to go straight to our retirement specialist here at the Fool and his terrific service. And I'm of course referring to Robert Brokamp and Rule Your Retirement. Now, Bro has 3 basic guides on Rule Your Retirement's website to help investors start assessing their portfolio and their allocations. Now, if you're more than 10 years away from retirement, then you really only need around 5% of your portfolio allocated to bonds. If you're within 10 years, then that number moves closer to 25%. And if you're in retirement, that number moves to closer to 40%. Now again, these are guidelines and they can differ for everyone, but I do think that one thing above all stands out here to me, and that is that the closer you get to retirement, the more you need to focus on protecting your wealth. You're either a younger investor and you're focused on growing your wealth, but the older you get, the closer you get to retirement, your priority needs to be on protecting your wealth. Now, while bonds may not be returning a whole heck of a lot today, you have to also consider your overall position and really the safety of that money. Try to assess your worst case scenario to get a better understanding as to what you can tolerate. And I think that'll help make the decision for you. While there's some there's some really great dividend stocks out there, for example, and their stock prices are being chased up right now by investors looking for yield because bonds are yielding relatively nothing. Now that's great. They're getting these great dividend stocks with great dividend yields. But what we're seeing is we're seeing some inflated stock prices with these dividend stocks, and there's room for these stock prices to fall, no question there. And you have to be aware of things like this because at the end of the day, capital loss is a capital loss, and that's just something you want to avoid at all costs, especially if you're closer to or in retirement. So this is just some food for thought. I mean, there's no single one answer to this question, but it's a great one to deliberate. I'm glad you asked it. So for more information, make sure to check out Fool.com.